if we can wait another.
All right, good morning, everybody. My name is Paul Shore. I'm at the University of Victoria in the economics department. And thanks again to the organizers for this wonderful conference. The organizers are the UVic Business School. Basma, thanks for asking me to be the chair of this session. It's a very interesting session. It's a doctoral student session. Doctoral students who have taken on the venture, I've understood from the keynote address yesterday, the venture to research sustainable finance. But we also learned from the keynote address yesterday that it's a venture that will ultimately pay off. We have 3 papers today. First paper is Pricing Climate Change Risk in Corporate Bonds by Elsa, ALLMAN of Baruch College. The discussant has connection issues, will not be there. If a person from UVic Business is around, Ali Shahrad, he may be able to provide some comments, but it's an uncertainty at this moment, and I haven't seen Ali around. Our second paper, the role of ESG in predicting bank financial distress, cross-country evidence, is by Alberto CITTERIO of the University of Insubria. Alberto is not around yet, but he will come in, I'm sure, in a short little while. The discussant is around, that's Claudia GIRARDONE of the University of Essex. And our third paper is the effect of ESG disclosure on corporate investment efficiency. And the presenter is Fran Wan, Baruch College, but it's co-authored with our first speaker, Elsa. And the discussant there is Ki Shu of the University of Victoria. The rules of engagement are once again 15 minutes for a presentation. Then the discussant will give 10 minutes, and then there's hopefully some time for a general discussion. Let's not destroy the time for the general discussion. So if you can present in sort of 14 or so minutes, then we all have time for transitions as well, and we should have a wonderful session. Without further ado, Elsa, the floor is yours. Elsa ALLMAN from Baruch College on pricing climate change risk in corporate bonds.
All right, thank you, Paul. Thank you also for the organizers for this great workshop that's very interesting and right in those great topics on sustainable finance and climate change. So I'm going to talk a little bit about my work on pricing climate change in corporate bonds. So the idea here is that we have increasing concerns about potential climate change bankruptcies and the cost of this climate change risk. So one example is recently in PG&E, which is a large utility from California, which bankrupted in January 2019. It was a bit of a wake-up call for companies to question whether they were really taking care of this climate change risk. And there's also been a lot of attention on different reports regarding the cost of climate change risk and how, for example, if we continue what we're doing right now, that means continuing in a warming scenario of 2 degrees, it might cost a lot of money for different economies. So what are climate risks first? Just a quick recap. And there are 2 types of main climate change risks. One is physical risk, which is going to be the focus of this paper, which could be understood as specific climate events such as hurricane floods or long-term climate change, such as sea level rise, and transition risk, which is more the idea of moving towards a lower carbon economy. So it can be from regulation or technology innovation. Why this is so important, there's also been a lot of attention in terms of policy. Working in a central bank, I see this firsthand. We're concerned that there's going to be a threat for financial stability in the long term. And markets play a key role to account for these potential future disasters by pricing these risks today. So this is even more concerning for investors who hold assets and want to know if this risk is taken into account. So one example is a survey from Kruger of over 400 investors, and over 34% of them have already agreed that physical climate risk is an important concern today and should be accounted for. So the idea in light of all of this context is whether or not corporate bonds are pricing climate change risk. The idea is that bonds should price these risks because they're a very big downside risk. And this is even more important than for stocks, where there is less of this important downside risk. However, it's not really clear if we can price such a long run potentially risk with high uncertainty and how to really measure this. I've chosen an approach looking at sea level rise, and I find in my analysis that it seems that if you focus on branch level locations, there is a climate risk premium in corporate bonds of approximately 7 basis points. And this is particularly the case in specific industries that are more vulnerable to floods or sea level rise more generally, and that are less spatially diversified, which means that they're concentrated in certain areas with shorter maturities, less than 10 years, and after the Paris Agreement. I don't find any evidence that it's the case that sea level rise is priced in credit ratings. I think this is really an important question because for the US market, the corporate bond market is really important in terms of financing. And also it's a topic that's really been talked about both by firms choosing where to locate and policymakers, as I mentioned before, in terms of financial stability. So how did I come about finding this research question? More generally, we've seen a lot of questioning in terms of both policy reports and in academia about whether or not climate change risk is priced in the market and in asset valuations. So for example, the Networking for Greening the Financial System, which is a network of central bankers, they wrote a report and they argued that climate-related financial risk was not reflected in asset valuations. Within the academic literature, which is growing and growing, I have listed a few here. Some have looked at the potential pricing of climate change risk in equities, real estate, also loans, and there's mixed evidence. To give an example, Murfin and Spiegel find that markets don't price sea level rise in house prices, but Bernstein, Gustafson, and Lewis in 2017, they find that homes exposed to sea level rise sell at a discount. So it's not really clear at this point. For municipal bonds, and I follow closely the paper by Painter 2020, both Painter and Goldman Smith Pickham and Al 2019 find some evidence of sea level rise being priced in municipal bonds in different ways. And for corporate bonds, there is a paper related to mine, which looks at whether environmental performance and regulatory climate risk is priced in corporate bond and finds some evidence of that. But nothing yet on whether physical climate risk is priced in corporate bonds, which is what I try to address. Just a little note, it's important to distinguish between environmental performance, such as ESG scores, or carbon risk, which is an externality, and regulatory climate risk, and physical climate risk, which is what I look at, and an exposure for firms. So in link with that, what I am trying to measure here and capture is when a firm chooses to locate its branches, what type of physical risk it is exposed to. So to do this, I follow closely Painter, who looks at municipal bonds, but I adapt the measure to firms. So Painter uses another measure by Hellgate and Al, which is basically the quantity of future flood losses in large coastal cities as a percentage of GDP. And the idea here is to have an expected loss measure that is an economic measure. So for example, here we can see New Orleans, the climate risk measure is such that it's equal to 1.5% approximately of GDP losses with a 40 centimeter rise of sea levels expected in 2050. Using this measure, what I do is I use data from Infogroup, which records business location of each company. I look at where firms have branches, and I create a sea level rise weighted measure using the Hellgate and Al and Painter and Al sea level rise expected loss measure. And I obtained for each corporation a sea level rise exposure measure weighted by sales, number of employees, and number of branches. The data sources I use to look at whether sea level rise impacts yield spreads are first bond characteristics obtained by FISD Mergent, which is the traditional data set for bonds in the US, issuer characteristics from Compustat and SEC filings, and as I mentioned before, from location from Infogroup. I'll skip the detailed summary statistics to go to the results, but there I construct basically an at-issue bond panel from 2010 to 2018 of over 6,000 bonds for 871 US public companies. So these are the main results. So here, as we can see, sea level rise significantly impacts yield spreads. For this regression here, number one in the baseline, it's equivalent to 1 standard deviation of increase of sea level rise equal to a 7 basis point premium, as I mentioned in the introduction. Here I look at the effect of sea level rise on credit ratings, and I don't find any significant effect. So these are the two main results. So I'll go pretty quickly on this. I run a bunch of robustness tests. Mainly, some concern is that firms choose to go in areas that are coastal counties that have a high density of population and certain economic conditions. And to deal with this and avoid bias from this choice of location, I run a placebo test and replace coastal counties by neighbor or matched inland counties with similar economic conditions, but no sea level rise risk. I also exclude firms that are exclusively located in coastal or inland cities with no sea level rise risk. I use inverse propensity weighing with a logic model to estimate the probability of being above sea level, median sea level rise levels. And I also check different sea level rise measures, such as using log and dummy sea level rise. More interestingly here, and I think this is one particularity of corporates that is really fun to look at, is the spatial dispersion of companies. So I use two measures. The first one is the number of counties. So to give an example, Netflix is going to be located in one county, whereas JP Morgan has branches over 2,500 counties. So I verify that firms that are overly spatially diversified, when I remove them, this is not biasing the results. So this is the first table here. And then I compare firms that are below and above median number of counties. So here, basically, I find that it's the firms that have this lower dispersion rather than being located in many, many different types of counties that are driving the results. And the results are similar when I use a different measure of concentration of spatial dispersion. I then look at vulnerable industries, and I find that indeed firms that are in industries that are more vulnerable, so these are agriculture, communication, energy, healthcare, transportation, as identified by Huang et al. In 2018, because their business basically is a type of business that is very sensible to climate and extreme weather conditions. So these are the companies that are the most affected, and in particular, energy. So one of the reasons I think other sectors here are not showing up is also because they have different levels of spatial dispersion. Finally, well, almost finally, I look at investment horizons. I find that the results are mainly driven by bonds that are issued for below 10 years. So this seems to be in line with the survey analysis from Kruger et al. That says that fewer than 10% of investors believe that climate risk will materialize only in 10 years or more. However, it also is a bit concerning because we would assume that given that climate change risk is a long-term risk, this should be priced in longer maturities, which I don't find any evidence of right here. Also, it's important to note that most of the bonds that I have in the sample are lower maturity bonds, so this also may explain the results. And last but not least, I look at whether the results differ in terms of period, and especially after the Paris Agreement, where a lot of attention was put in the media on climate change risk. And indeed, it seems like the 2016-2018 two-year period was the one where the results were driven, essentially, whereas before, it's either a bit less significant or negative for the 2013-2015 period. To conclude, I think I did exactly 15 minutes. So I find that a 1 standard deviation increase of sea level rise exposure results in a 7 basis point at issue climate risk premium. This is especially the case for vulnerable industries, firms that are less spatially diversified and with, let's say, short, medium-term maturities and after the Paris Agreement. I don't find evidence that it's accounted for in credit ratings, and this seems to be in concordance, let's say, with anecdotal evidence that credit rating agencies are just starting this process by buying climate data, for example, firms such as Moody doing this. I'm looking at for the future to do a little more in this analysis, and I'm really welcoming any comments. I'd like to look at whether specific short-term hurricane risk is driving the short-to maturity bond results. And I also like to look at environmental regulatory risk and insurance effects. And that's it.
Thank you very much indeed. Yeah, feel free to unshare your screen. Thank you very much. That was awesome, and thanks for sticking to the time. And it's like amazing. Yeah. You're the dream of every chair of a session. People stick to the timing. That's good. So let's move to general discussion. I see some hands are raised by Rim and Michael. However,
yeah, the discussant, the makeup discussant is here. I saw his name, so.
Yeah, and I'm just wondering whether Ali Shahrad from the UBIC Business School, whether you've had the chance to sort of take a look at the paper and provide some comments. And since you've been asked, I wanted to give you the chance first, but no pressure, right? Ali, how are you doing?
I'm good, thanks. Yes, of course, it's a pleasure to be here. Thank you. Thank you, Paul. Thank you, Elsa, for the presentation, for the great presentation. And hello, everybody. It's a great pleasure to be here with you today and discuss this paper. And as Paul mentioned, yesterday I learned about, that unfortunately the discussant is unable to attend the conference. And I was asked to share a few comments on the paper. And of course, I'm happy that I was given this chance. So I'll try to do that, and I'll try to keep my discussion brief so that there will be more chance for the audience to ask questions. Let me please share my screen first. And please let me know if you are able to.
Yes, the sharing started. You can see your slides.
Sounds great. I never learned how to do this quickly on full screening my. Okay, perfect.
Nice.
Perfect. Thank you very much. So this paper basically deals with the question of whether corporate bond prices reflect climate risk exposure. So basically, the question of whether the price of financial assets reflect climate change risk has recently gained a lot of attention in the context of real estate, equity market, bond market, and etc. As Elsa thoroughly reviewed the literature. So this paper focuses on the bond market to answer this question, and what distinguishes this paper from the rest of the literature on corporate bond is that it's focused on physical risk, and in particular on the sea level rise risk. And I think the reason that the previous studies has focused mostly on the transition risk could be partly because it could be partly based on the argument that the firms can hedge their physical risk exposure by relocating their firm to a safer areas. So it could be less of a concern, whereas transition risk is more inherent and fundamental to their business model. So what's nice about this paper is that it actually uses the geographic footprint of the firm to show that the physical risk, and in particular the sea level rise risk, is in fact priced in the corporate bond market. So there are a few papers that studies the effect of climate change risk on the fixed income asset, including sovereign bonds, municipal bonds, and corporate bonds. I'm going to skip the details on this slide, and because I believe that you got a good preview of these papers. And I'm going to move on to the methodology, the data, and sharing a few comments after. So basically, the data that is used in this paper is all US corporate bonds issued between 2010 and 2018. and for the maturities between 1 month to 30 years. And as a measure of the sea level rise exposure, the expected mean annual loss from sea level rise as a percentage of the city GDP is used. And this measure basically is estimated based on a 40 centimeter rise in the sea level in 2050 by Halligate et al. 2030. So this is a city level measure. Then it is aggregated to the county level, and then using several measures, including the fraction of sales, employees, branches, and rates, it is aggregated to the issuer level. So the based on the regression looks something like this. On the left-hand side, we have the bond characteristics that could be bond yield spread or the credit rating of the bond. And on the right-hand side, we have the, of course, the SLR measure, which is the variable of interest, and we have we have this area of control variables that basically includes bond characteristics such as the amount issued, maturity, and credit rating, and some firm characteristics including size, return on assets, and leverage, and etc. And of course, the year fixed effect and industry fixed effects are controlled for. So this is the baseline regression that is used to find some cool results. So just to summarize, the main result is that the one standard deviation increase in the firm's SLR exposure is associated with 7 basis point premium. So, so this is a nice result because of the argument that I mentioned earlier. And there are several checks and robustness tests done to make sure that these results are robust. So as mentioned, the results are mostly significant for short-term bonds. They're more significant for geographically concentrated firms, and within industries that are vulnerable to extreme weather conditions, and especially after the Paris Agreement, the results has started to become significant. So these are cool evidence that is in line with what we actually expect and in line with the hypothesis. And on top of that, there are some placebo tests and inverse propensity ratings done to make sure that these results are robust. So my view on the paper is that I think it's a nice paper. I find the evidence convincing, and I only share with you a few questions and comments that hopefully it clarifies some stuff for me, and hopefully it helps to polish the paper a bit more. So my first comment or question is about the issue of the unobserved country-specific local traits. So I think the paper addresses this issue thoroughly by controlling for a large set of bond and issuer characteristics, and on top of that, using placebo tests, the matched sample analysis, and the robustness checks. And all this alleviates this concern. However, my question is that whether can we exploit the time series variation in the risk exposure to address this issue further. In particular, can we use any definitive setting where we can control for fixed effects, so we are less concerned of those unobserved characteristics? So of course, the problem is that the exposure to climate change risk is slow moving. The risk will be realized over the course of 10 years, 50 years, or even a century. And I suppose the SLR measure that was suggested by the paper shouldn't have large amount of time variation because of the weights are being slow moving. and the measure is basically aggregated using time-varying weights, which is that's the only source of time variation. However, investors' attention, so the climate risk change could be slow varying. However, the investors' attention to climate change risk could be more time varying. So my question is, can we use this climate attention indices that are out there to kind of interact with these SLR to see whether the climate risk becomes more salient during the time that there's more attention to these risks. So a similar paper that I suggest as a first step that who does this type of analysis is Giglio and al. 2021, where they study the real estate market using the similar identification problem and index. So some suggestions. Yes,
Ali, it's Paul speaking. Sort of, would you mind squeezing your second comment into maybe sort of 45 seconds, if possible?
Oh yes, of course. Yeah. I'm sorry.
Simply because I need to protect some general discussion time here.
Yes, of course.
Thank you. It's very good. Thank you.
Yes. My second comment is about the SLR exposure measure. I think the paper mentions that this measure may be biased because of unobserved coastal counties. My question is that, is it possible to use a different SLR exposure that has more data availability and also higher resolution so that we can exploit the cross-sectional variation in the SLR exposure as well within counties, cities, or even zip codes? And some data sources to use is NOAA firm location and map it to, the SLR data from NOAA and map it to firm location. And my last comment, I'm not sure, Paul, if I can go over this. Just quick, thank you. Just quickly, the issue that I think Elsa also put it as a future venue to explore is long-term versus short-term risk, and whether the fact that the results are significant for short-term bonds suggests that these are driven by short-term risk exposure, and we can look at more like a storm risk exposure, and some sample analysis versus East Coast versus West Coast could also be helpful to see whether this is the underlying story that's driving the result. So that's all my comments. I'm sorry I went a little bit over, and thank you very much.
Ali, it's perfect. Thank you very much. And sort of again, sort of applause that you put something together so insightful in such a short time. Let me just immediately go to two people who have raised their hands. And Elsa, maybe there's no chance to respond, but I'm sure you're grateful for all the comments you get and can take discussions later offline as well, right? Rim, you had a question. And then after that, Michael and Elsa in the chat is a comment by Vikas. So Rim, go ahead.
Thank you, Elsa, for a very good paper. Have a couple of questions. First one, is there a way to find data, for example, on the insurance policies that companies have, particularly for extreme events, climatic events? This might eventually decrease the risk on certain, SLR risk. So this is my first point. The second point is there a way, for example, to look at the frequency of the extreme events? For example, because we can see that over the last years, there has been an increased frequency of those events. This means, why I'm speaking about the frequency particularly, it's because this frequency could eventually later on get connection with systemic risks originated from the climatic risk, which is very important in the medium to long run.
Awesome.
So this is something that probably you could start already reflecting about it. It doesn't mean that you need to treat this in the paper, but then eventually, if you continue working on this, you can think of this frequency, because we are moving now into higher frequency extreme events, climatic events, which eventually could have direct implication on SLR, so the sea level risk, which will have much more implications on the companies, particularly if these companies might not have a insurance policy put in place to deal with this type of events. And I would also think that to put a focus on the banking sector, because this banking sector on the asset side, we will see a lot of interesting things going on in the future. Thank you.
Thanks very much. Michael, a quick word of you.
Yes, thank you. Very quickly.
You started typing up something too, but
yes.
yeah, but feel free to speak up. Thank you.
Elsa, earlier in my career, I was involved in pricing corporate bonds in the United States, and I can tell you that the pricing at issue is very idiosyncratic and dependent on what's going on. So I would follow Ali's suggestion and look at the time series of the credit spread and how it reacts over time. You're going to get much more variation by looking at the time series. And in particular, you may want to look at how the credit spread reacts to storms. And what I've put in the chat is a database going back to 1950 of all storms hitting the United States. You can see if companies with bonds that have exposure, whether their credit spreads react, widen in response to those storms, or you could look at how their pricing has changed from periods earlier in the sample when there was no storms to periods when there is later, and do a sort of diff and diff for the same issuer. That's my suggestion.
Awesome. Elsa, with apologies to you, I'm just going to move to the second paper. I'm sure you're grateful for the comments. And so we're going to move to the second paper.
No worries.
Thanks for your understanding. And the second and third paper are both on ESG. So Alberto CITTERIO is the first presenter. Alberto, feel free to share your screen and speak to the role of ESG in predicting bank financial distress, cross-country evidence.
Thank you. So can you see the screen?
It's coming in slowly. Yes, it's there.
Okay, okay. Okay, so I have some problem with my connection, but I think it
seems to be going well. You can try Control L on your computer, but we can see it sufficiently well. Just feel free.
Okay. So good morning. I'm blessed to present you my paper entitled "The Role of the G in Predicting Bank Financial Distress Cross-Country Evidence." So I started with a brief introduction. Okay, so forecasting is a key issue in a managerial decision for several financial players, such as institution, with they can screen potential borrowers, setting the term of new loans, investors for bond pricing and portfolio management, and in particular for the banking sector, policymaker and macroprudential authorities for the surveillance and in order to take action to prevent bank from failure and to minimize costs for authority and taxpayers. It is important to identify a set of anticipating factors which can enable supervisor and manager to intervene promptly before the financial situation of an institution deteriorates further. I decided to focus on banks due to the peculiar characteristics of such sector. When problematic banks are identified too late, substantial costs are associated with their resolution, and when systematic banks fail, national and international contagion may happen. So my research relies on two strands of literature. The first is the large stream of research that focuses on the determinants and the predictability of bank failures. These studies show that the predictive model have almost always been based on accounting variables as independent explanatory variables, although several authors suggest the opportunity to include additional variables such as macroeconomic indicators and non-financial information. Accounting variables indeed suffer of some limitation. First of all, accounting reports usually depict a firm past performance and be not informative for predicting the future. In addition, accounting information could reflect the recorded book value of an asset and not the true one. Actually, while macroeconomic variables have been studied in several studies, there is only limited evidence of the influence of non-financial performance on banks' probability to be in financial distress. And it is particularly surprising since sustainable behavior has been one of the most pressing issues for society and stakeholders for several decades now. And with respect to the banking sector, the loss in credibility suffered during the global financial crisis induced banks to adopt social responsibility action. And in this context, the consensus about the ability of the banking sector to promote sustainable behavior through the lending channel has grown rapidly. So for this reason, this paper aims to fill the gap, supporting the hypothesis that the non-financial performance could reduce default probability. This hypothesis is supported by the earlier works that suggest a positive relationship between corporate social performance and financial performance. In fact, they can improve financial performance directly through an increase in financial returns or a reduction in the cost of the capital, and indirectly enhancing company reputation. Higher reputation may improve a bank's image in the market, allowing to recruit and retain the best talent and attract more creditworthy borrowers. All this benefit can contribute in the medium term to higher profit, better asset quality, higher financial condition, and consequently a possible reduction in risk. So these are the motivation of the work. First of all, investigate the relationship between financial performance and probability of default using a representative dataset composed of 362 banks from the US and the EU28, and to present a model that includes corporate social performance as a predictor. This study also provides a contribution to the methodological approach by means of a comparison between traditional statistical techniques, machine learning approaches, and ensemble methods. So for the analysis, I constructed an unbalanced panel composed by all the banks headquartered in the US and the EU28, for which was possible to collect financial and ESG information for at least 2 consecutive years within the reference period, for a total of 1,611 observation. So approximate bank risk using accounting-based variable and market-based variable. Firstly, I proxied the bank risk using a z-score. Despite the extensive use of this measure, there is a lack of consensus about a standard way for its construction. So I therefore compute z-score using different approach that is useful also to check the robustness of my results. To reduce the skewness of the z-score, we use the natural logarithm, which is normally distributed. Then I also confirmed the result using the method insert to default, where default occurs when the market value of a firm's asset falls below the face value of its liabilities. This measure was calculated only for listed banks. So I proxy non-financial information using the environmental, social, and corporate governance score provided by Thomson Reuters Refinitiv that provides annual score both as an aggregate and for each subcomponent, which allow to consider the overall effect of a comprehensive score and the influence of each component in the regression model. As control variable, in line with the literature, I focus on traditional camera indicators that capture credit, operational, and liquidity risk. So I introduce variables that evaluate capital adequacy, asset quality, management efficiency, earnings, liquidity, and a measure of income diversification. And I also included the CITTERIO and the inflation rate as a macroeconomic variable, and the Findal index as a measure of market concentration. So my analysis is composed by 2 different steps. In the first, I run an unbalanced panel analysis. This is the economic model, where DRM is the default risk measure at time t. I use 1 year lagging independent variable to reduce the risk of endogeneity caused by potential reverse causality or simultaneous bias, and CSR measure the sustainability performance at time t minus 1, approximated by this z-score in the first regression and by each single pillar in the subsequent 3 regressions. Then we have bank-specific control variable and macroeconomic variables. In the second step, I integrate a non-financial performance indicator in an early warning system, and I try to evaluate its gain contribution in the model. The mission is to identify a dummy variable to distinguish between financial distressed banks and the healthy banks. I therefore start from the definition of disease score to create such a 0-1 dependent variable. Since there is no a commonly accepted threshold that distinguishes between healthy and distressed bank, I systematically run each model several times to test the predictability using different thresholds. So I started to consider distressed the observation falling below the 5th percentile of the empirical distribution of disease score. Then I rerun the model using the 10th percentile and I continued up to the 95th percentile. The model is estimated using different approaches. Since there is no unanimous consensus on the best model to use, despite the widespread opinion that the ensemble classifier could generally outperform the individual techniques, I estimated the model using statistical methods, and in particular logic and linear discriminant analysis, artificial intelligence methods, classification tree, subtotal vector machine, and ensemble method, random forest and XGBoost. To strengthen the reliability of the results, the initial sample of banks is split into two subsamples. 70% is used as a training set for identification purposes, and the 30% to validate the model. The last issue addressed in the analysis is the choice of the cutoff point in terms of probability of failure that is used to assign an observation in the group of the distressed bank or healthy banks. In general, the standard approach assigns a value of 0 to an observation if the expected probability of being in financial distress is lower than 0.5. However, this approach may be inefficient because this cutoff may be not the cutoff that maximizes the overall accuracy of the model. I therefore use the Udemy index to identify this optimal cutoff, and it corresponds to the point where the sum of the true positive rate, it has the sensitivity, and the true negative rate, it has the specificity, is maximized. So I move briefly to the results. The first table shows that this G-score is significantly and positively correlated with the Z-score and the Merton distance to default, and thus negatively correlated with the probability of default, confirming the initial hypothesis that on average, banks with better non-financial performance are less likely to file in bankruptcy. With respect to the other variables, the table shows that capital adequacy, asset quality, earnings, and liquidity, and the macroeconomic variables are correlated at least one with the risk measures. Conversely, the cost-to-income ratio and the measures of income diversification are never found significant. For sake of simplicity, in this slide, I only report the coefficient of the three G dimensions that obtain with the three different regressions using the same dependent variable and contour variables as for the comprehensive score. The analysis showed that on average, all subcomponents are positively and significantly correlated with the default measures, and thus, also in this case, negatively related to the bank default risk. However, we can find that social performance is strongly correlated with the risk measure, indicating that banks that behave ethically and provide superior services are considered valuable by customers. The other two dimensions, even though they are significantly correlated with this score, show a lower magnitude. It could depend on different aspects. For example, improvements in managerial performance may take longer to have an effect, and the weak contribution of environmental performance could be justified by the still relatively weak focus on the environmental impact of bank activities. So shifting to the second part of the analysis, this table shows the out-of-sample predictive performance of the models. Specifically, the 6 models are compared using the Udemy index, which identifies the best threshold for each specification that minimizes the sum of the type 1 error and the type 2 error. In detail, higher value of the Udemy index imply better capacity of the model to reduce incorrect misclassification. From the statistical point of view, the figure shows that on average, the model follows similar patterns. However, the results support the opinion that ensemble models outperform single classifier, and in particular, random forest seems to outperform other algorithms in each estimation procedure. Conversely, among single classifiers, there is no clear difference between models. The analysis also indicates that the predictive ability of the model decreases as the percentile of the Z-score increases, when a higher percentage of banks are identified as distressed. This pattern probably implies that Z-score is particularly suitable for identifying banks, in particular severe financial distress. In these slides, I also report the confusion matrix. And we can see that in the 5th percentile specification, I report the confusion matrix of the model in the 5th percentile specification, where each model reached the highest performance. The table shows that the overall accuracy of model ranged from the 81 to 93%, and we can confirm that the predictive performance of the ensemble method is slightly better than individual classifier. Looking at the area under the ROC curve, we can see that models have similar performances, and each model seems to exhibit excellent accuracy, always over the 90%. Lastly, I calculate the improvement in predictive power of each variable, including the model. To determine the relative importance, I applied a different compatible method that I provided in the slides. After computing this procedure, I normalize the output of each variable importance method on a 0-100 scale for comparison needs. And this table represents my results. The x-axis represents the number of models where the variables appear in the top 6. The y-axis represents the variables average ranking across models. That is reversed so that the top variables are shown in the upper right corner. And the dimension of the circle represents the average importance. Although this may not provide a comprehensive description of the contribution, it shows a sort of general trends and provide maybe useful basis for interpretation. Not surprisingly, the NPL ratio and the return of asset are the most important factors across all the models. Among the others, macroeconomic factors display a relatively high importance. And with respect to this G-score, the analysis shows that on average, it occupies the 6th position among the 11 selected variables. And despite its relative predictive capacity, the SG score has a higher importance than more traditional variables, such as equity on total asset, the level of diversification, management efficiency, and also the level of total loans on total asset, which is never found among the top 6 variables, and for that reason, it has not been included in the figure. So concluding, higher level of the aggregated score correspond to a reduction in all risk measures, indicating that the achievement of sustainable goals not only have a potential positive effect on accounting and market performance, but it also contributes to reducing bank risk. In addition, SG score may have enough predictive ability to be included in more advanced prediction models. And with respect to the model I presented today, results suggest that the model can easily be applied to a large number of banks, even those that do not fail. And it has a very promising ability to distinguish healthy and distressed banks. And it indeed may have important implications for policymaker and macroprudential supervisor. Thank you.
Thanks very much. The discussant is Claudia Girardone of the University of Essex. Can you unshare your screen, Alberto? And then...
Yes. Okay. One second.
So it's the share screen button below.
Okay.
Yeah, that's awesome.
Okay.
Thank you very much.
Thank you.
Claudia, the floor is yours.
Yes, just a moment.
Yeah, we can see your screen share. It's not yet on full screen.
Okay,
Awesome.
can you see my notes or the full
Yeah.
screen properly?
Yeah, full screen is properly in sight.
Properly. Okay. So first of all, yeah, thank you for the opportunity to discuss this paper, which I very much enjoyed reading, especially because I'm working on similar kind of issues. So I've got, first of all, a slide on the aims, just to summarize what the paper tries to do. So the paper tries to examine the relationship between the ESG, both in aggregate and the single components, and bank risk measured both as Z-score, which is quite very much used in banking and is an accounting measure, and also a market-based measure, which is the Merton distance to default. And then there is this first part of the paper where these relationships are tested and with panel data, fixed effects models. And then there's the second part of the paper that looks at the predictionability of ESG score, developing a bank's financial distress prediction model. And as you could see, and Alberto did a very good job trying to compare different statistical and AI methods. So you have these from the traditional statistical techniques like the logistic regressions to machine learning approaches. So these are an ensemble methods, for example, the random forest and the XGBoost. I'm not an expert on these methods, so my comments, as you will see later, are generally more general on the first part and also on the structure of the paper. I'm aware Alberto is a PhD student, PhD session, so I need to give him the advice as I would do my PhD students. So the main findings in a nutshell are that using the panel regression models of risk measures on ESG, the paper finds a significant risk-reducing effect that is apparently primarily explained by this S of the ESG, the S component, which is the social. And then after evaluating this relationship, then the author develops a model to detect financial distress that includes these ESG scores as one of the predictors. And the findings are quite promising because they suggest basically what Alberto describes as an excellent ability to detect the bank's financial distress. There's a lot of tests that are being carried out in the paper. And so the main findings are that non-financial performance, which is the ESG rating, has a promising predictive ability that appears even higher than the accounting variables. So this is the main finding. So I've got several suggestions. So the first thing I would like to say is that it's certainly very much a worthwhile research topic, interesting to read, but I have both some suggestions and some concerns. So when I started reading the paper, I thought I was trying to find out what really was novel and what was the main contribution. And because I've done I have a study forthcoming on ESG and risk, and I know very well the literature. I think the main contribution of this paper is in the second part of the analysis. And the story at the beginning in the paper around Europe and the US sample is not, I mean, could be more convincing because the study uses both Europe and the US in a period where there's been quite a lot of changes in terms of regulation in Europe, for example, around ESG, and some countries in particular are more advanced in Europe, like France or Denmark. And so there needs to be more motivation, in my view, of why both US and EU are put together, a little bit about the ESG legislation and practices that are maybe different across countries, and why this time period really. Because this is, and what are the characteristics of this time period as well. So I think there could be more around that, because usually studies tend to do Europe, because that's where, you know, there's been more advancing regulation, advances in regulation, at least in the past few years. The other thing I would like to say is that there is nothing or very little about the theory. And I think it's important in such study to at least mention the relevant theories because they imply different relationships with risk. So you have on one hand the stakeholder view, on the other hand you have the managerial entrenchment and overinvestment view. We mentioned that in our paper yesterday. I think it's really important because in a stakeholder view, then the ESG investment is a kind of building goodwill, is a sort of insurance that generates moral capital. So of course, if it's like an insurance, then the relationship with risk is negative. Whereas when you look at managerial entrenchment and managers trying to show off that they care, but actually they don't care about ESG. So that's where the relationship becomes positive with risk, because the managers maybe just want to show that they care because they want to improve their ratings, but they don't actually do it genuinely to create goodwill around ESG. So this is really important. That has to be strengthened. And the hypothesis, I mean, there's mention of the hypothesis in the paper, but in fact, they're not properly set out, which I think at least one main hypothesis would help with once building up on the literature that is reviewed in the second section. Then, of course, there is the problem, at least in the first part of the paper, there is the problem of endogeneity, which is mentioned in the paper and noted, but that a reviewer could ask for more robustness checks. There's the problem of data sources, which, I mean, I have the same problem, so there's no solution. What usually is done is we use different data sets just to double check that results hold. And then
take a minute to conclude, Claudia.
Yes. So in terms of data and tables, we also have, I mean, as a reviewer, there are things that I feel that could be checked even before winsorizing. So I have reported here one table where I saw, for example, that, I don't know, total loans to total assets is 111%, which seems even if you winsorize, you need to check that there are no errors or non-performing loans are zero, these sort of things. So to sum up, last slide. So I think there is the innovative part of the paper is the second part, of which is on the financial distress prediction and machine learning approach, which I have not seen done in this way. And I think the first part, in a way, it's been done already. So less focus on that, more focus on the second part, and then in deciding which journal you want to target, which I think could be more of a technical journal. Perhaps refocus the paper to make sure that it fits well with a stronger focus on this second part. So overall, an interesting study, very relevant for policy and a lot of potential. So that's my my discussion. Thank you very much.
Wonderful. Thank you very much. Some questions from the audience. Rim, you raised your hand, so you go first.
Thank you very much. Very interesting paper and useful. I have one question because the result was quite intriguing. Of course, in view of the comments of Claudia, you might need to dig a little bit more into this link on the social part. And in my view, you should probably look at the business models of certain banks. Because some business models are different. Some of them are more socially oriented. Some others are more different. So you probably need to dig into the specificities of certain banks. I don't know, maybe you have done it, but this is probably one area where you could explore. I also share completely the view of Claudia that the value added of the paper is the second part, very important. I've seen a few papers that are trying to do the same on the first part. Probably you need to go into the latest literature over the past few years, but really focus on the second part. It's really quite interesting. If you
and what will be that? I mean, this is an interesting point, right? That you both make, but Claudia and Rim, what type of journals would be good for like a technical contribution of this sort, right? Because the background is of course banking, but you're saying that the innovation is really the methodological innovation. So which journal for that?
Good. Cool. I think you could go, for example, it depends, you know. Yeah, I think we need to, I need to think a bit more about it. But then because these are all predictive models for example, bank distress using ESG. So it's very, you could go also into, for example, journals of statistics or more very quantitative types, because now everybody wants to work on or they are interested to contribute on the climate change and ESG and all of these matters, and this can be very, you know, can be very good outlet, and you can make a contribution from there. Why not? Or try into eventually this business management, or yeah, you can think about it. Yeah.
And then presumably also change the title, right? I mean, it's like what can machine learning teach us about blah blah blah, right? I don't know. No, it's an interesting point. Anything else? Anybody? Just in keeping with the tradition in this session, I will not pass the floor back to Alberto, but sort of move to paper 3 so that we give everybody the chance. And paper 3 is on the effect of ESG disclosure on corporate investment efficiency. And Fran Won is the presenter. So Fran, the floor is yours.
Okay, I see my screen. Okay, perfect. All right. Good morning, everyone. Okay, so good morning. I'm Frank, and I'm from Baruch College, and I'm a 4th-year PhD student. This is a joint work with my colleague Elsa, who now is in Bank of France, and the project is titled "The Effect of ESG Disclosure on Corporate Investment Efficiency." There's been a growing demand for ESG-related information. For instance, institutional investors with 5 trillion asset under management petitioned the SEC in October 2018 to mandate sustainability disclosure in the United States. And the SEC subcommittee recommended mandating ESG disclosure in May 2020. Nonetheless, there is still an ongoing debate around whether to require firms to disclose ESG-related information still in the United States. So there is not yet an established regulation or law that requires firms to disclose ESG-related information. Okay. But then the literature on information disclosure suggests that in principle, or maybe put differently in theory, ESG-related information should have similar effects as the disclosure of financial information, given the fact that, just intuitively speaking, the quantity and quality of corporate information increases. And to recap on the benefits of the financial information, it includes tangible capital market benefits, such as improved liquidity, lower cost of capital, higher asset prices, and better corporate decisions. And within these better corporate decisions, there's a extensive literature in accounting that reports that improved financial information disclosure quality leads to better investment. Put differently, it improves investment efficiency through mitigating the problem of information asymmetry. But then it might be a bit hasty to simply conclude that, okay, ESG information will have same effect as financial information because the two types of information are different. So ESG information, first of all, caters not only to shareholders, but also to a wider range of stakeholders. And furthermore, ESG information is not yet well standardized as financial information are. So it is ex ante uncertain how much and how well firms will supply new information. And to further talk about the literature on ESG related information, the literature currently mostly focused on the effects on, say, the firm valuation, the stock returns, and also the CSR activities of the firms. But then the focus is less. The literature focuses less on the corporate, the firm's financial decisions, such as investment or capital financing decisions. So this leads to our research question, which is, does increase in quality of ESG information disclosure improve investment efficiency? And to add on to kind of develop the idea of investment efficiency, it's essentially whether or not the investment decisions affected by market imperfections, such as information asymmetry, those problems mitigated through firms disclosing more or better ESG related information. Okay, so in the past, like the standard literature such as like Stiglitz and Weiss, 1981, where firms underinvest due to capital rationing by creditors. Those are the investment decisions that we're trying to argue that is happening. So, but then I'll get to that when I talk about the results. And to answer this question, we apply a difference in difference approach to mitigate any potential co-founding factors. It is, even though we use a regulation that originates from the European Union countries, it is a within country setting, which focuses on the US firms, so that the shock could be more random to the subjects in question. And it is a regulatory shock which increases ESG disclosure quality of firms exposed to the EU directive. It's also known as the NFRD. And of course, we will validate our claim that the treatment group, the firms that are exposed to the NFRD, indeed were acknowledgeable of the shock and changed their disclosure policy. To summarize our results indicate the following. First, the US firms which anticipated the implementation of the NFRD increased their disclosure quality, validating that our shock does indeed trigger firms to increase their disclosure quality. Second, this improvement leads to investment efficiency to the firms exposed to the NFRD. And lastly, we find empirical evidence that such firms increase their debt issuance and experience a reduction of bond yield spreads at issuance. Of course, there was a comment in the first presentation that the yield spread at issuance is a noisy proxy. So that's why we complement the results by showing also evidence from the issuance side. So both are complementary. The potential explanations of these empirical results are the following. First, it could be that there is indeed a reduction of information asymmetry between the firm and the debt investors. So then it would be that since debt instruments are more exposed to downside risk. Elsa talked about climate change. There are other downside risks such as default risk. And the information asymmetry problem, the literature talks about adverse selection problems and moral hazard problems, but then it could be more about the moral hazard problems, such as a firm having weak corporate governance or having manager entrenchment problem, which acknowledging these problems, creditors ex ante ration credit. And this leads to an underinvestment problem that is theorized by Stiglitz and Weiss in 1981. And this could be a potential explanation. And then the second explanation could be that these firms are window dressing. Basically, these firms are exploiting the opportunity that the ESG related information is popular. So they disclose more to gain more access to the external capital. But then our cross-sectional analysis indicate that the effects that we are capturing in the investment policies are more pronounced in the firms that have weak corporate governance, and the firms that are more susceptible to manager entrenchment problems. So this leads us to think or conclude that it is indeed the first story and less related to the second story. So to talk more about our difference in difference design, the NFRD is a shock which increased ESG disclosure quality of US firms, which I will show you anecdotal and also empirical evidences. It is a shock that it is a regulation that required environmental, social, and employee matters, a disclosure of these matters, respect for human rights, anti-corruptions, all related to ESG related information. And this mandate was for the public interest entities with 500 employees or more, which have significant activities in the European Union countries. So what we do is we use the CompuStat segment data to identify firms that have branches in the European Union, and of course with 500 employees or more from the CompuStat database. And for the difference in difference design, the after variable, it starts in 2015, since the NFRD was announced in 2014 to observe the post-adoption changes. And the third thing that I want to point out before I move on to the results is this Overfirm measure that we use to argue that the firms are gaining efficient investment efficiency. It's a measure that is widely used in the accounting literature, and it measures the likelihood of a firm to over or underinvest based on cash and leverage. So I put one example here. So for instance, a firm that has low cash and high leverage would have a low Overfirm measure. They are susceptible to an underinvestment problem due to, if it's a moral hazard story, it would, it also can be an adverse selection problem. There's subjective credit rationing problems, and it will lead them to underinvestment. Or you can also say that high leverage leads to a debt overhang problem. Firms are reluctant to invest because of their high leverage ratios, and also leads to underinvestment. So these information asymmetry stories all evolve around low cash and leverage. So that's why we claim that this Overfirm measure very cleanly captures these problems and helps us show that there are changes to the corporate investment policies.
Right. So for your results and conclusion, you have about 3 minutes, right?
Okay, thank you so much. So our data consists of US firms. The treatment firm is the 162 firms exposed to the directive, and the control group is the firms based in the US that are not. And so these anecdotal evidence show that firms that are exposed to the directive, you see an increase in the ESG disclosure quality measured by Bloomberg. However, the firms that does not operate in the European Union, they do not change their disclosure quality. And this is a formal test that illustrates this point. And this leads to, so this, before I introduce the Overfirm measure, this is an evidence that shows that firms that are more likely to underinvest increase their investment level after the treatment, of course, for the firms that are exposed to the directive. But of course, we can't run this three-column regression all the time. So we use this Overfirm measure that is simpler and also is more consistent with the financial disclosure literature. And you see that this coefficient over here, positive, shows that firms that are susceptible to the underinvestment problem are increasing their investment. However, the firms that are susceptible to the overinvestment problem, it is not as robust. So that leads us to say that it is the NFRD disclosure is affects the firms which have underinvestment problem. So I'll just skim through the results from the financing side. So similar, the interpretation is very similar. The firms that are subject to the underinvestment problems, they increase that issuance. And then for the spreads, this is the last slide that I will explain in the presentation. So we see that the underinvesting firms, indeed, their spread decreases. But interestingly, it is more pronounced in the longer maturity bonds, which is kind of tied to a story that that could be tied to the story that ESG-related information has a longer horizon. It contains an information that has a longer horizon. So that's why it is being incorporated more into the longer maturity bonds instead of the shorter maturity bonds. And the rest is a cross-sectional analysis that shows that the results are more pronounced in firms that have corporate governance issues or management entrenchment issues. Okay, so I will conclude here. Thank you so much. And yeah, I hope to chat with you soon. I'll stop my share.
Wonderful, Fran. Well planned. I was just getting a little concerned because at some stage you were at slide number 6, but you had figured it out and you figured that you wanted to talk more about the method, and I think it was a good choice. Thank you very much. The discussant today is Ki Xu from the Department of Economics at UVic. Ki, floor is yours.
Thank you very much, Paul. Let me find my slide. Can you see my slides?
Yes, we can.
We go full screen.
Yes, perfect.
Perfect. My name is Ki Xu, and I'm assistant professor at University of Victoria. Thank you very much for giving me the opportunity to discuss this paper. So this is a really great conference. I enjoyed, I enjoyed very much. And I also really like this PhD session that we got to see some young scholars and their excellent work. So I really enjoyed reading this paper, and I know that I'm very impressed by it's a paper written by 2 PhD students. I remember when I was a PhD student, I also co-authored with my PhD classmates, we each also have our own job market paper other than the co-authored paper. And it's a lot of work to work on both your own job market paper and the co-authored paper. And eventually our co-authored paper, the co-authored paper with my classmate get published. So I also sincerely hope that your co-authored paper can get published. So I have, let me see, let me go to the next slide. So first of all, let me have a quick recap of the paper. I think Frank did a good job presenting it, so this part will be really quick. So basically, the motivation of the paper is to look at the disclosure of ESG information and the effect of that on investment efficiency. So the mechanism goes through from this disclosure of ESG information to investment efficiency are through a few channels. The author has mentioned in the paper that disclosure of this non-financial information could mitigate adverse selection and reduce information asymmetry in the market. It could also lower the cost of capital, have better liquidity, and improve long-term performance of the firm, and eventually can lead to higher asset prices. And all those mechanisms can lead to change in investment efficiency, the investment level of each firm. And the author find that, so the main result, the really biggest thing come out of this paper is that they find the disclosure of ESG information improves investment efficiency. And they use data from several different resources. They link and combine the data, and they use a policy change as a policy change that improve the disclosure of ESG information as an identification strategy. They did careful analysis with numerous robustness tests. And that's excellent work. So I will dive directly into my comments because the author already did a good job presenting the paper. So my first major comment is that I'm a little concerned about the definition of investment efficiency. So in your presentation, in your paper, you mentioned that the way you measure this is based on another paper, and you define overinvestment as you identify overinvestment as a firm has high cash holdings and low leverage compared to their peers, and underinvestment as low cash holdings and high leverage compared to their peers. But when we talk about investment efficiency, the reference point should be the efficient level of investment, right? The optimal level for each firm. And that optimal level either could be a profit maximizing level of investment or welfare maximizing level of investment. In finance, I would say that it's probably from the firm's point of view, it's probably profit maximizing efficient level of investment. And that level of investment that optimal level should be different for each firm, right? Rather than, you just compare to their peers, whether they have low cash holding, they're underinvest, you define them as underinvestment. I'm a little concerned about this. Although maybe in the literature, this is the way people measure overinvestment and underinvestment. But I think it would be nice if you can address this in your paper, saying that this is a compromise. This is not a direct measure of investment efficiency. And how you cannot get a direct measure, so you have to go with this compromised measure. Again, I think it would be nice to point out that what's the efficient level for each firm that you couldn't observe directly, and that will help to clarify what you mean by investment efficiency. Hope that makes sense to you. And my other comment is that so in terms of your identification strategy, it's really smart to have this policy change that there is a mandatory requirement for this non-financial information disclosure as a shock on the quality of ESG ESG information disclosure. Okay, so if we look at your estimation, your regression equation here, you use this policy as an identification, use that as a dummy variable, right? Treatment is the firms who subject to this policy, and after is when after the policy is implemented, and those are all dummy variables that that shows that will pop out the effect of the policy. My concern, not really concern, my question here is that if you have a direct direct measure of the ESG disclosure score as a continuous variable. Can you do this regression using this continuous variable and show that the effect of this the effect of ESG disclosure on investment efficiency is still the same. So I think this policy is a good identification. But a more direct measure will be the ESG disclosure score, if you can observe that directly, right? And then the regression that you did with all the policy dummies shows the effect of the policy on this investment efficiency. But if you can directly observe this continuous variable like this ESG disclosure score, I think it will be helpful to also use this continuous variable to do the regression, show whether your results holds. Yeah, and then let me see. Oh, my time is almost up. So for future work, I just quickly have a suggestion for future work. A more direct mechanism between ESG disclosure, the effect could be on the firm's green investment rather than investment efficiency, which, you know, the definition is a little bit. If you can look at the firm's green investment, you can identify that. Then you can look at ESG disclosure and the firm's investment in green project, whether there's any change in there. Okay, lastly, I have two minor comments. Let me quickly talk about them. So in your control group, you have a treatment group and a control group. In your control group, you included firms that have less than 500 employees. But I think it probably will be helpful to remove this group because the firms with less than 500 employees are smaller firms. When we do this difference in differences regression, we want the control group and the treatment group to be similar to each other than the treatment, right? To be very close to each other. So those companies with less than 500 employees are smaller ones that's immediately different from the treatment group. I would suggest you not to include those parts in your control. And then what else? Yeah, and then
that point will be understood by the speaker. So let's move to general discussion. I see a hand raised by Vikas Mevrota. Vikas, floor is yours. Thank you, Key.
Okay.
Well, thank you very much, Paul. So first of all, a really interesting paper. Really enjoyed your presentation as well. I have a suggestion to look at the cash flow sensitivity of firms that voluntarily disclose ESG information. And that would be a good way to understand if some of the things that you mentioned regarding underinvestment, which was sort of in the framework of if you want to really go back in the Acker law for Myers and Majluf framework, how does disclosure mitigate the problems of informational asymmetry? And so looking at the cash flow sensitivity of investments to internal cash flows would be a good way to do this. There's a huge literature on that, and I can recommend you some papers if you want, but there's a very large literature on that. That's all I have for a suggestion, but very good work. Enjoy it.
Can I ask, like, so I missed what was the sensitivity measure you just mentioned? Like the voluntary
investment cash flow sensitivity. So the simple, you would run a regression of.
No. The one that you mentioned before, the voluntary disclosure of ESG related information. Didn't you talk about some kind of a sensitivity measure?
That might be in the Vikas put a reference to a paper in the chat.
Okay. Oh, right.
I'm assuming that it's from
a paper by Matsumura et al., which came out in the accounting review, which I put in the chat. So you should have a look at that.
Oh, okay. Okay. Thank you so much.
Anybody else? My comment is probably one of presentation. So if you speak of underinvestment problem a lot, right? But in the literature, there's like a difference between sort of like credit rationing and underinvestment, right? So underinvestment is more from an ex post point of view, right? So I would just speak of credit rationing if that's what you're talking about. And the underinvestment problem is the problem that once firms have accumulated the debt burden, right? There's like this debt overhang or underinvestment problem, right? So check it out and then see what the value of this is. Anybody else? If not, then let me just conclude this session. And sorry for not always getting back to the speakers, but I thought let's run a tight ship on this session because the conference is packed, right? If you look at the program, there's 2 more sessions in the morning, and then there's a lunch break, obviously, for the people on the Canadian West Coast, and a late lunch break for people in Mountain Time, and an even later lunch break for people in Ontario, and then a dinner break, I suppose, for people in Europe, and a nighttime break in the people in Asia. But and then afterwards, there's a very interesting session on clean tech, and you need to sort of register sort of separately for that. So that's why I thought, okay, let's use at least the 15 minutes of breathing time. Having said that, Basma just indicated that she can sort of connect up people in a separate sort of breakout room if there's a need to. And also, I suppose that, you still have 5 minutes to sort of chat before sort of the next chair will start to organize stuff. So maybe I'll just hand back to Basma for a concluding word, but thank you very much to all the speakers, to all the discussants, of course, the people who made comments in the general presentation. Wonderful session. It will not be as good as this session anymore, but it will still be a really high quality conference to come. Thank you.
Thank you, Paul, very much. Indeed, Cheryl is able to send groups to breakout rooms in case you want to chat. We can try this and see how it works. I don't know if you can pre-select where who to meet, but we all there are great people in the session, so I'm sure you will enjoy meeting randomly without any pre-assigned rooms.
Yeah, my prediction is that it will be complex, but
and feel free to take a break if you don't want to join.
Yeah, but we could also just continue
totally optional,
for
right?
Like 6 minutes, and then probably the next session chair wants to sort of line up all the ducks, right? That's what I felt like. Oh, do we have all the speakers? Do we have all the discussants? It made me a little nervous, right? Yeah.
We leave it to Cheryl.
We leave it to Cheryl. Exactly. Thanks.